Hello, friends. Many of you might be, tired of investing, your hard-earned salary in the wrong way. And, you are losing money in risky investments, or you might be confused about where to start. Again, this is not only your problem, and you're not alone in this. Many people fall into the trap of, putting all their money in one place, maybe in cryptos by seeing this lucrative move, or even the stocks, seeing that bull run during 2021 to this period of time, and eventually end up in heavy losses. So, what I'll be doing in this session is I'll be showing you the smart way to invest your salary, and thereby you reduce your risk and also you will maximize your return. So, this is going to be simple, practical, and also tailored for every type of investor. Okay, whether you're salaried or if you're doing business and whatever you are doing, still it is going to be useful. So, before we talk about where to invest, let's try to understand one golden rule. So, that is very simple. Don't put all your eggs in one basket, right? So, what is required here? Diversification. And diversification is the secret to building wealth while protecting yourself from heavy losses. So, whether it is crypto or stocks or fixed deposits or mutual funds or whatever, relying on just one asset is a recipe for disaster. So the goal is to balance your portfolio across multiple investment options. So if one fails, the other can make up you for that. For example, if you see during the COVID time when the stock prices were crashing, gold was going up very aggressively. So that's why the diversification is very important. Okay. At the same time, I'm not against the conventional investments like fixed deposit or part of your investment you can do in that way also. So because we will be discussing short-term goal, medium-term goal, long-term goal. Based on that, your investment type also will vary. So let's try to understand or know your investment type. So the first step to smart investing is knowing what type of investor you are. Uh, if you are slightly aged, then you might be a conservative investor, or you can be an aggressive investor if you are young, or a balanced investor. So when I talk about conservative investor, you don't want to take risk and prefer stable returns. When you talk about the balanced investor, you're okay with small risk and you want better returns. So you are slightly, above than this conservative investor in that scale. And when it comes to the aggressive investor, here you are ready to take big risk for higher returns. And these are the people who invest heavily in this, small cap and everything. So understanding your type, you need to know which type you are. It actually helps you to decide where to allocate your salary and avoid unnecessary stress. So let's look at conservative investors. So those who are playing it very safe. So if you're a conservative investor, focus on safety and stability. For short-term goals, that means up to 3 years, you can allocate, let's say, 20% to your equity through Nifty 50 index funds, which is very low risk. At the same time, there is a steady growth also. And 80%, see, I'm talking about conservative investor. So I won't be discussing too much about, other investments. So 80% can be fixed deposit with higher interest, like those offering 9.5% through platforms like, there are different platforms. I don't want to name the platform anyway. So for long-term goals, means more than 3 years, you can reduce the 50. That means FD. That means you can reduce it to 50%, and then you can make 40% in equity. So you understand, if your goal is short term, I'll be going more with fixed deposit and less with equity. But if I have a long term goal, I slightly change the ratio: 50% in FD and 40% in equity, like Nifty 50, mid cap, small cap mutual funds you can do, and 10% in gold ETFs for added security. So this strategy basically ensures that your money grows steadily without unnecessary risk, because I'm talking about a very, very conservative investor. Now coming to a balanced investor, that means a mix of safety and growth. See guys, whenever we talk about investment, you need to look into three aspects. So you will look for safety, you will look for liquidity, and you will look for return. So safety, liquidity, return. Okay. So what's the issue with stocks or equity? It's not safe. It is risky, but liquidity is high, return is high. Okay, but not safe. Risk is there. When you talk about real estate, it is safe, no issue. Return is also there, decent, but is it liquid? Can you sell the land at any point of time when you want to sell, just like stocks? No. So it is not liquid. Now coming to fixed deposit. So it is safe, of course, and it is having decent return also, the one which I've told you. But is it liquid? No. So the issue is you won't get all the three together. You need to compromise on any one of that. That's why you need to understand what type of investor you are, what are your demands and requirements, and based on that, you need to have diversification. So here, if you're a balanced investor, means mix of safety and growth return. So your goal is to achieve slightly higher returns. At the same time, you are able to take or accept some risk. So for short-term investment, for you people, it is 50% in FD, 50% in equity. That again, you can split into Nifty 50 and mid-cap mutual funds. Let's say Nifty 50, 30% or 25%, mid-cap mutual fund another 10%, small cap mutual fund another 10%. That way you can do. Now for long-term investment beyond 3 years, then reduce that FD to 20%. You don't want too much, in FD. That is not going to beat inflation also to, or just beat inflation. There is of no use actually. So let's say 20% to FD. Still, we will be maintaining some conservative approach here, and 70% in equities, including, it can be individual stocks from Nifty 50 itself or Nifty 500 you can select, and the one which is potentially doing good you can select, and 10% in gold ETFs for more diversification. So this balance again gives you chance to earn higher returns at the same time protecting the portion of your capital. Slightly small risk is there. Now coming to aggressive investor, that means you are taking bold steps. You are a young and vibrant investor. Okay, so for aggressive investors who are ready to take risk, so the strategy changes. And for the short-term goals, here we definitely need some portion in FD. So 30% in FD, that will provide you that stability. 70% in equity, where it could include the Nifty 50. It could be individual stocks, mutual funds, again, mid cap, small cap, and strategy funds. So here you can again divide, right? Nifty 50, maybe 20%. Individual stocks could be HDFC. Some stocks you can pick ICICI, where you see the potential, and that can be 20%. Mutual funds, another 10-20%, or 10% each in mid cap, small cap, large cap, and the strategy funds. That way also you can diversify. If it is long-term goal, again, reduce that FD to 10%. Just 10% is enough. 80% in equity. That again, you can split 40% in individual stock, because you have more than 3 years. So go with stocks. Okay, that is better. But take a potential stock, ICICI or HDFC or Reliance or whatever you feel like. 20% in strategy mutual funds, and 10% each in mid cap, small cap funds, like that. 10% in gold ETFs, again, for added diversification. So this approach will maximize the growth potential while keeping some small safety net also at the same time. So see, I've discussed about, there are, platforms. I'm not naming it. Platforms, make investment, smarter and simpler. And these platforms are also allowing you to compare FD rates across 200 plus banks and choose the best ones without opening multiple accounts. So you can even instantly withdraw funds when needed. And for gold investments, you can explore ETFs, which are again liquid and easy to manage. Okay, so see, no matter your investment type, whatever it is, rebalancing is essential. That means every 6 months, check your portfolio, and you need to adjust it to maintain your desired allocation. For example, if stocks perform well and take up a larger share, then what you need to do, reduce your equity holding. So when the stock is performing well, what will happen? In your entire portfolio, the stock percentage will go up. So what you need to do is shift that to the other instruments. Okay, so you need to maintain that percentage. So you reduce your equity holding and move funds into safer options, could be ETFs or FDs. So this keeps your risk in check. Always, always you need to do this. Okay, so how can I conclude? To sum up, smart salary investment. So it's not about luck, it's about strategy. You need to understand, you need to have a mentor, you need to discuss, and you need to know things and understand your investment and invest what kind of investor you are. Diversify wisely, know the requirements, and rebalance regularly. There are platforms which can help you to get the best returns with minimal effort. So remember, it's your hard-earned money. Invest it in a way that will secure you and your future and your future generation, and will also help you to achieve your financial goals as well. So guys, that's about this session. Thank you so much for watching. If you find this helpful, do like the video and share it with your friends. So see you guys. In case if you need any help, you can get in touch with us. Thank you so much.